This is a video that explains or attempts to explain from an introductory level the workings of the Federal Reserve System. The Federal Reserve Bank is the central bank of the United States. It's one of the largest central banks in the world, since we have almost a $25 trillion economy. The Federal Reserve is their main purpose is to modulate and protect the integrity of the United States currency, the dollar. So what the Federal Reserve attempts to do is to make sure that inflation does not get out of control, and I'll explain that in a minute, and also that the economy doesn't slow too much, which is what they're dealing with right now. The Federal Reserve is led by Janet Yellen. She's the first female head of the Federal Reserve and an economist by training. She is the head of the Board of Governors, which is 12 regional bankers and herself, together with these different advisory council, the Federal Advisory Council, the Consumer Advisory Council, the Thrift Institutions Advisory Council, the advisory committees. They're basically made up of business people, people from academia, government officials. They weigh in on the inner workings of different parts of the economy within the United States, help the Board of Governors make decisions on whether to modulate interest rates by either raising them to slow down the economy or lowering them to increase velocity in the economy. This Board of Governors, they oversee the banks, the member banks, and all member banks within the United States, and they set their rules for the banks. So there you have it. They have a Board of Governors. There's the Open Market Committee, and the Board of Governors of the Fed oversees the Open Market Committee. What the Open Market Committee basically is a big trading desk. And when the Fed wants to modulate interest rates, their number one tool is to use the Open Market Committee. Now, the Open Market Committee will buy Treasury securities to lower rates and sell Treasury securities to raise rates. So think about it like the Fed having an open checkbook. That's the only entity in the country that could just write checks or create money. Obviously, if they create money too quickly, they're going to create too much money. Imagine if everyone had $1 million in their bank account tomorrow. Sounds like a great idea, but the price of bread a loaf of bread would probably become $100 or $200 because there'd be too much money chasing too few goods. That's a dramatic example, but the example of what inflation means in an economy. So it's the Open Market Committee that buys Treasury securities when they want to lower rates. By buying the securities, they're actually giving the banking community cash. And remember that interest rates are an inverse function of demand. In other words, when there's a lot of cash looking for lenders, think about this for a minute, when there's a lot of cash looking for lenders, interest rates will go down because there's more cash than people who want to borrow. And that's what the Fed is doing right now. They're flooding the markets with cash by buying Treasury securities and lowering the rates of interest. And if the rates of interest are low, you're not going to keep your money in the bank. What you're going to do is invest in either businesses or buy capital goods or buy homes. That's the hope. In this economy recently, we haven't seen that because of the regulatory and the banks coming out of 2008 are not lending they're lending to large borrowers, but they're not lending to smaller borrowers. So that's created an issue for the Fed, and it's created an issue for the economy. But that's what they do. And then when they want to raise rates, because inflation is getting out of control, almost like when you hit the brakes on a car, then they will sell Treasury securities and take cash out of the market. And the Open Market Committee does those things. So thinking about it, they sell the securities. In other words, they're borrowing more money. They're taking cash out of the economy. Because less cash is chasing more borrowers, think about the supply-demand economic relationship, rates will go up. And when rates go up, it pays for you to keep money in the bank and not invest in homes or businesses or the stock market. So you see the stock market doing very well right now because rates are so low, and there really isn't an alternative to investing in the stock market, which is not the best reason for buying stocks. You'd rather see just solid earnings. Low interest rates are not the number one reason why you want to buy stocks. You hate to do something because there's no other way to do it. The other thing you should be aware of, these are the 12 central banks. And you see basically what we've done is divided the economy in 12 regions. The original banks, almost like the colonies, it kind of reminds me of that. You have Boston Bank, you have the New York Fed, New York being a financial center. Philadelphia Fed, the Richmond Fed, which kind of handles the Mid-Atlantic states. You have the Atlanta Fed, which has Florida and Atlanta. The Chicago Fed, and Chicago being one of the central parts. You have the commodity exchanges. A lot of the markets come out of there. The St. Louis Fed, in the central region of the United States, the Dallas Fed with the oil economy, the Kansas City Fed with the Midwest economy, Minneapolis Fed, large amounts of natural resources in that region, and borders Canada, which is our largest trading partner, by the way. And then finally the San Francisco Fed, which handles the vast West. And of course we know we have technology, military contractors, entertainment, tourism, agriculture. Las Vegas is located there. A lot of business comes out of the West. So you have the 12 central banks, and that's how the Fed divides up the economy. So interest rates are the main purpose. The Fed has some other tools in their economy and in their arsenal. One would be the discount rate, and the discount rate is the amount of money that member banks charge each other. There's the Fed funds rate. There's overnight borrowing by banks. Think about the banks in this country as having these big checkbooks. And at the end of the day, all of the transactions that occur with our money cards, with our checkbook, paying bills, collecting money from your employer or from another business person, all these things get netted out at the end of the night. And if a bank needs money, they're able to borrow it from the Fed or from other member banks. Those rates, the higher they are, the more reluctant banks are to lend money. The lower those rates are, like the discount rate, the more aggressive banks will lend money because rates are lower. Basically, their source of funds has gone down. So the discount rate, the federal funds rate, those are all ways for banks to source funding to lend. The other tools in the Fed's arsenal are the margin requirements. That's how much money you have to put up to buy stocks. That hasn't changed much since 1929. It's basically 50%. And then there's jawboning, which is basically verbiage from the Fed bank governors, where they'll talk about the economy. In a slow economy like this, they'll talk up the economy. And in a very booming economy, they'll talk down the economy. But the one thing you have to realize is interest rates are a function of demand. And the more cash out there chasing less lenders, the lower the interest rates are going to go. The less money and the more lenders, the supply-demand function is going to turn, so rates will go up. And when rates are high, people will leave their money in the bank. Makes sense, especially fixed income or retirees. But when rates are low like they are now, retirees are getting very little from Social Security. They're not earning a lot of money from their retirement accounts. So ergo, or therefore, they are going to put money into the stock market. That's the yield curve. And the yield curve is a visual view. It's a normal yield curve. On this axis, on the y-axis, you have the yields, which go from 0 to 3.5%. And on the x-axis, you go from 0 maturity to 30 years. And you can visualize rates going up. Rates are a function of time. Think about it. The longer you want to borrow money, the more you generally have to pay. Credit, the better your credit, the lower the rate. The worse a company's credit, the higher the rate. So you got time as a factor in interest rates. Your credit, like your credit score, like a person's credit score is going to be a function of credit rates. In companies, they get credit ratings. Countries have credit ratings. That's going to determine the amount of interest you're going to have to pay. So you have, those are two of the big factors, time and credit. There are other macroeconomic factors, but those are the two I want you to focus on. So we will have more videos, but this is an introductory video of the Fed and the structure of interest rates. And stay tuned for more videos as we move along. Thank you.